All right, Chapter 4, Completing the Accounting Cycle. Nice thing about finishing this chapter is the rest of the chapters is really just a little bit of a repeat of the first 4 chapters, just going in a significantly greater detail regarding specific subjects. But the process of the journaling, the posting to your ledger accounts, and preparing your financial statements will now be repetitive after this chapter. So let's go ahead and get into it. Benefits of a worksheet. It is not a required report. It's just an aid that accountants have found this to help simplify the process. And it's an aid for preparation of the financial statements and closing your month-end, quarter-end, and specifically your year-end. It helps reduce errors. It keeps a list of your adjustments that you need. It helps in planning and organization for audits. So there's a lot of benefits for developing a worksheet. And this is also going to be, by the way, your project coming up after the conclusion of this chapter, because I do want to cement this process early in your academic career, because it'll make the rest of your accounting education significantly easier. So let's look at the process here. Your process obviously begins with number 1, journaling in your general journal, your transactions in chronological order by date. You then post those journals to a ledger account. And then at the end of some accounting period, whether it be the month, the quarter, or the year, you will then prepare a trial balance, an unadjusted trial balance. And this is the beginning of your worksheet. And you have your unadjusted trial balance here, and you make sure that all your postings balance. If not, you have to go correct it, because anything going forward will just be a continuation of that mistake. Once you do have it balanced, you then make your adjustments for the end of that period, which we've already studied in Chapter 3. Make sure those balance, and now you do an adjusted trial balance here. So this is the basic of your worksheet. From there, we have to now record closing entries. And what we mean by that is you got to, especially at the end of the year, you have to reset your income statement. That income statement starts all over for the whole new year. And to reset that, you have to clear out all the revenue and all the expense accounts. You have to draw those balances back down to 0 so you can start the new period at 0. Again, think of it as the trip odometer in your car. When you start your new trip, you push the button and it sets everything to 0. That's what closing entries are for the accountant. And we record them and we post everything into a new T account called the income summary. And the closing of that will be moved to the balance sheet. So we have what's called temporary and permanent accounts. The temporary accounts are your expenses, your revenue, i.e. your income statement, your owner's withdrawals, and your income summary. And why this is temporary, these will be closed out at the end of the year and moved over into the permanent account, i.e. the balance sheet, your assets, your liabilities, and your equity, owner's equity account. And so this will then clear this out so you can start the new period. Recording closing entries. You need to close the credit balances in the revenue accounts, and you create an income summary account. And this income summary account is not going to be long living. It might be just for a minute or two. But you close it out to the income summary, you close out your revenue accounts, and you close out all your expense account to the income summary, and then the remaining balance, you take the balance of that and you close that to the owner's capital account. And then you close the withdrawals for that period to the owner's equity account. That's all there is. It's not that confusing once you've done it once or twice, and the homework will help cement this process. And again, you use the adjusted trial balance because now this is post your adjustments. So you've done your unadjusted trial balance, you've done your adjustments, now you've done your trial balance, and now you go forward from there. And you close out your revenue accounts. So you take these 2 revenue accounts and you put it into an income summary account. So here you are, you debit, debit, close those out, and then move it into your income summary. And then you simply put the explanation there. Again, you're taking, this is the summarizes in your ledger account what's happening. You're closing this out, so you have a zero balance. You're closing this out to a zero balance, and you're moving it into the income summary account. And then you're going to do the same thing with your expenses. You take these expenses here, and you move them to the income summary. Again, to close the expense account. And here's your ledgers showing that all these balances are now reduced to zero. You move it over, and now you have your net income from this amount. So you have your, here's your closing expenses, your closing revenue, and then you have your net income. And that net income is then moved over to the capital account, i.e. the owner's equity account, to close out this income summary. So this income summary's shelf life is literally a minute or two. That is all there's to it. It's just a transitionary account to move everything over to the owner's equity account. Again, you're just moving this over. You're adding that income summary. You're closing out the year, literally right here. You're taking it from the income summary, moving it to the balance sheet under the equity account. And then now your income statement is set to zero to start the new year. Close out the withdrawals for that period. You're going to move it out and move it into the capital account. Again, you move it to the capital account, the withdrawals to the capital account, and you have a new position for your capital position. So that's really what the closing entries are. It's just closing out those accounts for that year. And here's your summary. You close out all of the expenses into your income summary and move the balance over. And the collection is in your capital account. And when we get into corporations, this is what's called the retained earnings account. Post-closing trial balance, now you list all your permanent accounts, and it should be really your balance sheet. And here you are. Here's your post-closing trial balance. And everything should be really your balance sheet. You notice there's no income statement here. So here's your accounting cycle. You analyze your transactions, you journalize it, post it to your ledger, your unadjusted trial balance. I'd remember this slide because I am going to probably put this as a test question. Make your adjustments, adjusted trial balance, prepare your statements, close out that income statement, prepare a closing trial balance, and then you're done. A little bit about what's called the classified balance sheet. And a balance sheet is actually formatted in a very structured way. And basically we put items in the asset and in the liability accounts in order of liquidity. The most current is up top, and then you go down to your longer term. You'll have current assets, non-current, current liabilities, and then your long-term liabilities. Current assets are expected to be sold or collected or used within 1 year or the operating cycle. So anything a year or less is considered current. More than a year is long-term. And that's a key point. You do need to remember that. Long-term investments, again, you're holding for longer than a year. And we're going to go into much greater detail in later chapters regarding that. Plant assets are long-lived assets such as your equipment, buildings, land, and what have you. Now you can have also intangible assets. Intangible assets are assets that it's created by law. For instance, your copyrights, your patents, your trademark. They don't have a physical form, but they do have a legal presence and can be significant value sometimes. Current liabilities, again, are again obligations that are due within 1 year, and long-term liabilities will be over a year. That's the separating between the current and the long-term, is the 1 year or a company's operating cycles. Equity is the owner's claim on the assets. This is a restatement of Chapter 1, literally. And let me get into another ratio here. Current ratio, used a lot by the banking industry. It's how much is your current assets over your current liabilities. This really does show the ability of the company to be able to pay its current obligations. And it is tracked significantly by a variety of analysts, Wall Street, and of course your creditors and so forth. So it's a fairly standard ratio. There is a more advanced ratio that we'll get into at a later date, but you do need to know this ratio. And that is it for the chapter. It was a fairly short chapter. Hope this helps, and I'll see you at the chapter 5. Thank you.